Good morning, afternoon, or evening, depending on where you're coming in from, and welcome to our webinar. We're pleased to have you all here. This is actually the second webinar that we're organizing as a build-up to this conference, the conference Unlocking Solar Capital Africa, that we will organize end of the month, 25 and 26 October in Abidjan, Côte d'Ivoire. This webinar is called Commercial Capital Investments in African Solar PV Projects, which is one of the most interesting topics that we will also discuss in the conference. Today with us are Charles Ayenu, who's the Regional Coordinator of Ceadir West Africa, and Jan Malan, Principal Transactor of Nedbank. And they both have a lot of experience with this topic, so I'm curious to hear their insights. I will quickly run you through the agenda of today. I will give a short introduction of the webinar and of the conference itself. Furthermore, after that, Charles and Jan will shed their lights on several of the key topics, like their perspective on the international and local commercial banks, what they can do in financing solar PV projects in Africa, their experience from previous projects, and key considerations for investing in solar PV projects in Africa. In the end, after their presentations, there will be time for Q&A. You can ask questions, and we will be able to. I will ask the most interesting questions to Jan and Charles. You can ask these questions through the chat box that you have on the side of your screen, and I do like to encourage you to really use that. It will be an interactive session, and you can ask questions to either Charles or Jan or both of them. If you have any technical issues, please use the chat box as well. We have staff available here on site to help you. And the presentation slides and recordings will be uploaded soon as well. So if there are colleagues or people that missed the webinar, they can also listen to it. Or if you want to just listen to it again later on, that's also possible. Shortly on the conference that this webinar is related to, it's called Unlocking Solar Capital Africa, and it will be the second edition of this event. Last year we organized it in Nairobi, and it was a very successful event with more than 350 people involved. We decided to move to Abidjan this year in Côte d'Ivoire because it's a Pan-African event. Therefore, we moved it to West Africa for this edition. We organized it together with GOGLA, the Global Off-Grid Lighting Association, and therefore we can make sure that there is a fair representation from both the on and the off-grid sector. Most of the people involved in the conference are either financiers, project development executives, but also all the other key stakeholders from the African solar market will be there. And like I said, it's taking place in Africa, in Abidjan, more specific. And on the bottom of the page, you can see the URL. So if you want to go, you can also go to the website. This will also be shown later in the webinar again. Some of the key sponsors and partners that we have for this conference are shown on the screen. A few that I want to highlight are organizing partners Power Africa and Proparco, and our diamond sponsors CDC and Total, who have provided strong support in the organization of this conference, and who will all be there with a strong representation as well in a few weeks. Registration for the conference is still possible. You can do that on the website that you just saw. Shortly about Solarplaza, we are established in 2004, and our goal is to empower professionals in solar business development by building the most valuable solar PV network. We do so by organizing conferences and trade missions all around the world. We've organized over 90 events already in more than 30 countries, as you can see on the map. But we also do this by writing reports, articles, and organizing webinars, for instance. That's enough about us. Before we head into the webinar, we have one poll question that we would like to show on the screen, because we are interested to hear what kind of people we have in the room. So I'm just going to launch it now. So if I'm correct, you now see it on the screen. And the question is, what sector are you mainly interested in? Is it A, off-grid, B, mini-grid, C, CNI, or D, on-grid? I see you're already actively voting. I will leave the poll open for a few more seconds so that you can make your votes. Just 5 more seconds or so. Most of you have voted, yes. Okay, and we will go to close it now. So, and then the results will be shown on your screen. There you go. Okay, so there's a fair, I would say, a fair balance between the different sectors. But what's interesting is that there is quite a group that's interested in commercial, industrial, and on-grid. I think especially Jan's presentation touches more on the on-grid projects, and Charles' presentation is more focused on, well, I think all the different segments. So that's very good that we have a good representation from all sectors. We will now continue to go with the presentation, and starting with Charles's presentation. Charles is the regional coordinator of Ceadir, which is the climate economic analysis for development, investment, and resilience from USAID. Charles has extensive banking experience. He worked as a financial credit mismanagement and relationship manager at Citicorp, and recently as a senior vice president at SunTrust Bank in Washington, D.C. Furthermore, Charles is also the CEO of Home Energy Africa, which is a renewable energy company developing projects primarily in West Africa. His company's first undertaking is a 100 megawatt solar PV project in West Ghana, and it's expected to reach financial close soon. I'm now going to invite Charles to the stage. Charles, are you there? I now just unmuted you, so can you hear us, Charles?
Yes, I'm here.
Perfect. I'm going to give you control over the keyboard and mouse now, Charles, and then you can start your presentation. If I'm correct, you now have the control.
Thank you, Adrian.
When you click in the presentation, Charles, and then you can move the presentation.
I don't see the presentation here.
Okay, otherwise I can move it for you. We now have the first.
That's good. Thank you.
Perfect. Okay, then you can just tell me when you want to move.
Okay. My name is Charles Sena Ayenu. I am the West Africa Regional Coordinator for USAID Climate Economic Analysis for Development, Investment, and Resilience, CEDAR. I work with a team of local financial experts to assess the clean energy market in 8 West African countries, 4 Francophone countries, Côte d'Ivoire, Guinea, Niger, Senegal, and 4 Anglophone countries, Ghana, Liberia, Nigeria, and Sierra Leone. I'm based in Accra, Ghana, and I oversee the regional activities of CEDAR. Next.
Yes.
Next. CEDAR is a 5-year USAID funded global activity that is helping countries to assess and scale up low carbon climate resilient development in Central America, Asia, and Africa. Overall, CEDAR works in over 17 countries to conduct economic, financial, and other analysis needed to make the business and economic case for taking strategic climate adaptation and mitigation actions. Next. CEDAR activities in West Africa focuses on 8 West African countries and will continue through September 2018. There are 3 major tasks under these activities. The team finished the first task, where we interviewed over 50 commercial banks. We also met with several local energy sector regulators and independent power producers during this phase. The team is now actively involved in the second task, which consists of the market assessment, the bank diagnostic, and the capacity development in all 8 countries. In this particular phase, we received commitment from over 30 banks that are willing to continue with Ceadir activity. This represents over 60% participation rate when compared to the banks we initially interacted with during our scoping visit. Next. In the next 2 slides, let's go over some of the challenges to scaling up commercial bank lending for clean energy projects. Our overall observation about the banking sector across the West African region can be summarized as follows. The banking staff lack of knowledge about clean energy technology, business model, and suitable loan product mix. This is where we see the importance of human resources and the need for capacity building. 2, the banking sector also faces stiffer regulation, mostly imposed by the central bank in each country, high interest rates, high cost of lending, and so on. Lastly, bank lending policy imposes high collateral requirements as high as 140% of the loan amount, with relatively short tenure loan of 3 to 36 months. Clean energy projects require longer tenure of about 10 years or more to make them bankable. Next. Another key element that is discouraging banks to lend to clean energy projects is the lack of standardization of clean energy equipment used in these projects. The use of high quality clean energy equipment becomes critical as the value of the main collateral being pledged is in the equipment. The standardization or certification process also increases the confidence level of the bank to rely on the value given to this equipment. ECOWAS Center for Renewable Energy and Energy Efficiency, ICRE, is in the process of setting up such standardization mechanism, which is very welcome by the bank we met with. Currency mismatch and local currency risk represent another key barrier in encouraging lending. Many developers are new entrants in the industry and lack necessary robust project business presentation and guarantee to attract bank financing. This is more pronounced when it comes to the off-grid sector. One major challenge that the developers are still facing in the region is the fact that central bank regulation hinder the bank ability to lending. The prudential requirement that led to high collateral requirement can be cited as one example. Another example is the guarantee requirement to support clean energy credit facility. Next. As you can see in the graph on the screen, average commercial bank interest rates in the region ranges from 9.25% in Senegal to 27% in Ghana, with other countries in between. These high interest rates hamper clean energy financing and development in the region. For consumers of clean energy to find value for money, credit facility from banks should have a longer tenure. Commercial banks can explore options with donor agencies and development finance institutions to develop innovative financial products and instruments to support clean energy products. Financial institutions we interviewed indicated a strong willingness to mobilize resources for lending to clean energy sector at lower interest rates and longer tenure. Next. The Ceadir activity brings several benefits to the participating banks. Few of these benefits include a greater understanding of clean energy lending markets and specific opportunities. As part of our activity, all banks will receive the final copy of the market assessment report that our local financial experts prepare for the 8 countries. Another valuable added benefit of our activity is the fact that the bank diagnostic report we are currently working on with the participating bank will help determine the work plan, the type of training, and the technical assistance that will be needed by the bank. New clean energy credit product development is also part of the benefits available using our clean energy lending toolkit, CELT. Next. The key finding that resulted from the market assessment we conducted can be summarized as follows. Banks need to increase their expertise on clean energy lending. The majority of the banks we met expressed interest in increasing clean energy lending. Some banks established or thinking about establishing new department for clean energy lending. The banks also stress the fact that they need support in obtaining new sources of long-term financing for their clean energy loan portfolio. Emphasis was put on the need for faster implementation of the standardization of clean energy equipment certification in the region. Most banks we met with are interested in the USAID Development Credit Authority, DCA, and other partial loan portfolio guarantee programs. The market assessment in the 8 countries showed sizable opportunities in lending to the off-grid distributed energy sector. Next. When it comes to the bank diagnostic, the key findings that we can share as of today are the following. Over 30 banks in 8 countries have demonstrated strong interest in participating in Ceadir activities and benefit from the technical assistance and new product development. Banks have dedicated and committed staff to work with Ceadir team on the bank diagnostic reports. To conclude, the bank diagnostic will enable Ceadir team to recommend training, workshop, new credit or loan products for clean energy sector and other technical assistance to the participating bank through mid-2018. Next. These are the key contacts of Ceadir activity team. Next. Here you have the web link of the Clean Energy Lending Toolkit, commonly called CELT, in English, French, and Spanish. Thank you for listening.
Thank you, Charles. And yes, thank you for this very interesting presentation. Before we head to our second speaker, Jan, we would like to ask you a second poll question. And also, yeah, so here it's coming. It's now on your screen. The question is, what profile will best describe your company? Is it A, a project developer, B, a financier, C, a consultancy/law firm, D, a manufacturer or distributor, and E, an other company type? And again, it will be interesting to see what people we have in the room. I'm sorry that some of the categories are multiple companies at once. We couldn't add more categories than this. I see most of you have voted by now. We will close it in a few seconds. And then you will get the results on your screen again. So interesting, we see that most of the people here are project developers, and you all fit in the categories that we outlined. Very interesting. Thank you. We will take this also into account with the Q&A, which I want to remind you of. Please ask your questions if you have any in the chat box, and we will touch upon them later in the Q&A. Now, first we will head on to our next speaker, who is Jan Malan. Now it's going to show on your screen, and here it is. Jan is a principal transactor with Nedbank, the South African big commercial bank. Jan has previously been a senior investment officer with the African Development Bank, and therefore, both in his previous job and in his current job, has a lot of experience with financing energy projects throughout all of sub-Saharan Africa. Also involved in all these projects, he was in the financing of over 400 megawatts of solar PV in South Africa in different projects. So without further ado, I would like to give the slides to Jan. Jan, are you there?
I'm here. Thank you, Adrian.
Okay, I will now give you control over the mouse and keyboard. Let's see if it works with you. So you can click on the presentation and start moving it. Yes, perfect. Jan, you can start.
Yes, thanks. I'm just I'm trying to get to the next slide.
Yeah.
Great. Thanks, Adrian. Thanks for the opportunity. I'm going to try and keep it short so we can leave some time at the end for questions. I think what I'm trying to outline here is probably the main thing that we do here, which is the on-grid sort of larger scale utility type project financings. It's not to say we don't do other off-grid stuff, but this is kind of the bread and butter and what has really kept us busy over the last few years, both in South Africa and the rest of Africa. So what I try to do in this slide is really perhaps just give a sort of a brief outline of what a typical project finance structure would look like. For the benefit of the audience, this middle block is really the key to the whole thing. We call it a special purpose vehicle, which is just a fancy name for basically a project company that is created specifically to own the project and own the assets of the project. So everything revolves around that structure, and the idea behind it really is to ring fence that project and that cash flows in a specific entity that makes it easier to finance, particularly a greenfield standalone type project. And as you can see, just by benefit of the arrows, the green arrows indicate kind of where the project funding comes from. This one comes from the debt side. This is where the equity guys come in, and this is where most of that funding goes to construct the actual project. There's also other things that needs to be funded, but that is the main goal. And then once the project is successfully constructed and is in operations and starts generating electricity and needs to get paid, this is where the revenue stream comes from, where the off-taker is very typically a local utility that is in a power purchase agreement with the SPV, and that's really where the cash comes from. It flows through the SPV, funds the operations, and also repays debt and allows for a dividend stream to equity. So the beauty of the limited recourse structure is because of these projects tend to be very capital intensive, needs a big capital outlay, and accordingly often really requires a big portion of debt. This structure limits the the obligations and the liability really of the shareholders, where they may not have the capacity or have the inclination to sit with these large amounts of debt on their books. In the case like this, the recourse of the banks are to this vehicle only, and all the assets and cash flow that sits within this vehicle. And this makes it very attractive for shareholders. The challenge it presents to the debt side of the equation is that because the debt's only recourse is really in this project and dependent on this cash flow stream coming from the off-taker, the banks need to get very comfortable with the project, with all the risks inside the project, whether it be technical risks, contractual risks, or then probably the main risk, particularly in the African context, the off-taker risk, the risk of not being paid by the utility and or the government doing something that compromises the project. Given that the loan profiles of these deals for them to work need to be very long-term, because you're tied to a tariff that needs to make sense for the off-taker and the consumers that they need to go and sell to, it only really works with long tenor debt and fairly high gearing in this deal. So to be able to do that, it is fairly high risk. From a bank's perspective, you need to survive a number of presidential elections, and you need to be fairly sure that that project will be able to generate, the necessary electricity for, whatever it might be, 15 years or even longer. So a lot of our focus, and here we sit on the right side of the screen, the commercial banks, is in getting comfortable with what's going on here from a contractual perspective, and in the project itself. And as you can see, here sits the development finance institutions, which tends to lend next to us. We partner with them very typically on these deals for all the benefits that they offer, whereas we have a purely commercial outlook. The development finance institutions have a strategic view on the development and may be able to stomach certain risks that the commercial banks are not able to stomach. And that's why the partnership works very well, because we can offer the sort of the commercial structuring abilities and make sure that the deal is efficient. And of course, we can raise additional capital, whereas the DFIs can partner with us and create that, whether it be a halo effect or even direct support in terms of mitigating certain risks and sharing certain risks that make it imminently financeable for the commercial market. And here you can see this is the very typical setup where there's some kind of political risk insurance or export credit agency cover, or whether different forms and shapes that these things take to get the commercial banks comfortable, and often also get even the equity comfortable, that sort of the governmental risks, the non-payment risks are duly mitigated, and that makes the deal imminently financeable. So just moving on to the next slide, where we talk a little bit about the typical role of the commercial banks. We've touched on some of this. I'm not going to run through all of it, but we believe that our value add is that we are commercially incentivized, and that creates efficiencies for us. We believe we can be quite quick to structure these deals. We obviously have deep relationships in the financing world and can mobilize capital. We tend to be able to tap into resources not just within our team, but within the bigger investment banking structure. But to give you an idea, in the Nedbank case, at the moment, we have 13 professional deal makers that look just at energy finance in Africa. So there is a fair amount of resources to mobilize. We can be reasonably flexible and innovative around structures. Ultimately, it's really about the risk for us, and if we can understand that risk and package it properly, we can do the deal. So we're not tied to particular products. Risk benchmark really speaks to, I think, if you see projects where there is an appetite from the commercial market, that gives you an indication that the risks are probably nicely sort of allocated and packaged. If you have trouble getting the banks attracted from a commercial perspective, it probably means there's some risks that are a little bit difficult to deal with and may need some attention. ECA facilitation, we have a dedicated ECA team that maintains relationships with all the big export credit agencies from around the world. And this we find is certainly one of the major sort of funding vehicles that can mobilize large amounts of money from around the world at fairly competitive rates. And then we can offer obviously the other peripheral services like hedging, accounts, agency functions, etc. So the main challenges we face, we've touched on this, really center around, I think, the political and country risk, and how do we deal with that, and how do we get comfortable with that. It really comes down to a pricing issue. Whether we can participate or not is certainly one issue, but the other one is simply, we need to price the risk that we see in front of us, and to the extent we get that kind of support from DFIs or from ECAs that help carry that risk for us, that allows us to price more competitively, maybe extend tenors, etc. It also speaks to, when we talk about country and political risk, it's not just about government, it is also about non-payment risk of the utility, which is probably the most typical thing we encounter. Quite often utilities are under pressure, not necessarily financially very stable, and they can run into issues. And in cases like that, it's very important to understand how to mitigate that. Ideally, you don't want to default the project and put the country short of electricity. You want to have solutions in place to deal with that sort of short-term liquidity issues. And if it then becomes a governmental, political issue, that there are mitigants at that level as well. The commercial default requirements, that's really a fairly specific thing that speaks to where we lend next to our DFI friends, where we are mostly aligned, but we do have slightly different approaches to contracts, where, because we're a commercial outfit, we need to be able to exercise rights, whereas DFIs can perhaps be a little bit more patient, try and work out deals. So there's a little bit of a point where we sometimes need to arm wrestle a little bit with the development institutions around how to get comfortable. And then, of course, the last one, which I think Charles also touched on, cost of funding, a major challenge for all the commercial banks, particularly after the financial crisis. Project finance is seen as a fairly risky type of lending, and the capital we have to allocate against that is certainly becoming more and more expensive. So to the extent we can also access relief through the development institutions, that allows us to lower our cost of funding, or at least shrink our margin, that makes it more doable. But this is certainly one of the things that we grapple with on an ongoing basis. Then just on a couple of points which are more deal specific. These are the typical risks that you would see in any sort of limited recourse deal. Specific to PV, I would say, is the resource assessment. This is absolutely critical, to have a high quality resource assessment, to understand what the radiation is, and how predictable that radiation will be, to offer the yield and the revenue stream that makes the project doable. The other things are fairly self-explanatory. We'd like to see high quality equipment. We need to understand the risks imminent in the transmission system and the grid, and the costs involved in connecting to that grid, and how stable is that grid, and who takes risk for any transmission connection. Environmental and social, very important. We're an equator principal bank, which are most of the commercial banks, so we need to tick that box. And then the construction and the operations process. The construction, really key, is the quality of the engineering contract. Is it a fully wrapped contract? What kind of risk sits with the contractor versus with the owner or the borrower? How long, is the construction process? Does the milestones make sense? Is there a sort of a mechanism for penalties as well as termination rights in the case that things do go wrong? And the same sort of thing with operations. We'd like to see somebody with experience. We'd like to see a contract that has a little bit of length in it, so that there's a little bit of skin for that operator in the game, and that he does assume the obligations that we would like to see him assume. I think one of the key lessons of project finance is that risk needs to be allocated to the people best placed to deal with that risk. So during construction, we'd like to see the contractor take most of the key risks, and during operations, we will try to place risk on the operator that we believe they can deal with, and the rest of the risk will sit with the borrower and implicitly with the lenders. Financial considerations, we obviously take a close look at the shareholders and the equity coming in. We like to see strategic investors that have done it before, that understand how these projects work and have the resources and the ability to be able to manage projects of this nature. That being said, purely financial investors play a very important role in making these projects happen, but we do take a lot of comfort from guys that stick around and do know how to manage and operate these projects, and have the sort of resources that can step in if things do go wrong or needs to be fixed. Cash flow, this speaks really to the financial model and what that cash flow stream looks like, the risk inherent in that power purchase agreement and how predictable that cash flow is, and what the risks are related to cost overruns or operating increases, maintenance, etc., so that we can get comfortable that the cash flow is robust enough to cover the debt repayments. Liquidity and reserves, this speaks to the things we touched on earlier, related to if there are late payments from the utility, is there some kind of liquidity buffer that we can access to keep the project kind of ticking over until those payments come through. Reserves for things like debt service, maintenance, etc. It really depends on the particular transaction, but these things do provide us with a lot of comfort around, keeping the project afloat in the event of, short-term challenges. If, of course, it's a big challenge, there's not much to be done, but you don't want to default the project if you have any choice. Convertibility and transferability, I think that speaks to currency risks. Most of these transactions on the bigger scale happen in US dollar, whereas PPAs tend to be linked to, US dollar, but tend to be in local currency. We need to be very comfortable that one can convert that currency and that one can move it abroad if necessary, and as may be required by both equity and debt in the deal. Speaking about contractual risk, these are the typical things. Charles also touched on this. Regulatory weakness is certainly a challenge in a lot of African countries. We'd like to see a legal framework that gets us comfortable and accommodates the private sector and IPP specifically, to the extent where you can get comfortable that there's enough buy-in from government and that they will step in and support utility as may be necessary. The PPA needs to be bankable. This goes without saying. Government support, not just the banks, but I think the insurance market likes to see clear government support in some form or another to get them comfortable that government is committed to the particular project, and that allows them to get comfortable around offering insurance to that project. Direct agreements, this is the typical things banks require with the various parties. In case the borrower is in default that they have to step in, they can communicate directly with the EPC contractor, for example, or with the utility. The interface, this really speaks to how wrapped are these contracts and how nicely do they dovetail with each other. We'd like to see things pass through nicely. If there's obligations at the PPA level, it finds its way into the terms agreement that the banks have with the borrower, and to the extent necessary might find its way into, for example, a construction contract or an operating contract. Termination provisions, the standard kind of stuff. One needs to understand, who's responsible for what, and at what point do you run the risk of termination, and at one point can you exercise your rights, depending on what side of the table you're on. And then enforceability. So typically we'd like to see international law being applied, something like English law in the Anglophone countries, and arbitration offshore, so that one can get that sort of international stamp of approval and access courts where you have a lot of comfort that things will not be influenced by whatever political climate might be prevalent in that country at a particular time. And it just gives a lot of comfort to international investors and opens a big market for international players to come in. And that's the whole story. I mean, that last slide is really just a nice picture of a fairly large scale PV project in South Africa, 75 megawatts, one of the number that we financed in recent times, and that we're extremely happy with. Very, very good radiation results, and a very successful project. And this shows, I think, that it can be done. There's no reason why we cannot replicate this across Africa. Africa has some of the best resource out there, and here's hoping that the future will be able to tap into that. Thanks, Adrian.
Perfect. Thank you very much, Jan. Yeah, we saw quite some questions coming in during both your presentations, and I want to encourage you to keep asking the questions. First of all, so I will ask you both some questions, but also Jan and Charles, feel free to respond on each other or ask each other questions. And the first question that I wanted to ask was one to Charles. Charles, the question is that most development banks are leaning towards the provision of low-cost debt, and the question is, what's the market need, do you think, for early-stage equity, and if any, do you see any parties providing that?
Thank you for the questions. I think the early equity in projects are mostly coming from investors. Most commercial banks are not really looking at initial equity investment in renewable energy projects, which become a challenge for many developers. So what we see across the region that these developers are struggling to find equity partners, but as now projects are really getting improved when it comes to the quality of the business proposal or the packaging, we can see that some of them are attracting foreign investors, which are mostly coming from overseas. But when it comes to the local commercial bank, we don't see their involvement so much when it comes to that equity piece when it comes to development.
Okay, another question, this one for Jan. Jan, there was someone who was curious to hear if you have heard about the put and call option agreements that are currently being used and in contracts to mitigate political and government risks, and if so, what your opinion is on this solution.
Yes, now we've seen this come into the market in recent times. I believe it, in fact, often comes from the donor side of things, where understandably I think donors are reluctant to want governments to enter into too many obligations, and in the old style was a sort of a ongoing government support agreement where, you know, government steps in and pays as soon as a utility doesn't pay. The put call option agreement is really more of an all fall down scenario where if you have a default and you just want to get out, you can sell the project to government. So it is a slightly different risk profile, but we think it's manageable. I think the big difference is because you don't have that ongoing support from government, your project might have to have additional liquidity in the project to protect you on that ongoing basis in case of late payments or things like that. But we do believe it is workable, and it has been banked, I believe in Nigeria, for example, and Ghana is also moving in that direction. And we have to see the details, of course, but certainly we think it's workable. It does change the risk profile slightly. You might have to build your liquidity a little bit more during operations on an ongoing basis, but in theory, it can work.
Yeah, I think I will add to that in most, I would say Ghana, for instance, in the past, they have used sovereign guarantees, which these days are no longer being offered. And most of these countries are replacing such guarantee with the put call options. And that's the case of Ghana as well.
Thank you for that. And interesting indeed your response on that as well, Charles. Charles, I have one more question for you as well. You mentioned a lot of challenges for commercial banks to lend for clean energy investments. Is there any of these challenges that you see as most particular, that's the biggest challenge for most of the banks?
Yes, I think I did mention during my presentation about the standardization, which become a critical aspect when it comes to financing for some of these banks, because they are questioning a lot about the technology used, how reliable the technology, because at the end of the day, the collateral that the developers are pledging lie in those equipment. So that become one of the key elements that some of these banks that we met across the region are emphasizing. So it's very important to create that standardization that I talk about, and ICRE is working on that project when it comes to the ECOWAS region. So that's one element. And the other element that create those kind of challenges is the collateral requirements, because most of these banks are really asking for very high ratio when it comes to collateral requirements. I did mention up to 140% collateral, which create a lot of challenges for the developers as well.
Interesting. And Jan, for you the same question. You also mentioned a lot of risks. What do you see as the biggest risk, the biggest hurdle?
Well, I think to you know, maybe complement Charles' presentation, I think the big risk is in fact regulatory in country nature. I think the biggest challenge we find that the most typical thing we have to deal with is a non-payment scenario. Given the long tenor of these transactions and the often sort of unpredictable political climate, a lot of countries in Africa are still very young from a political perspective, a democratic perspective. So there is certainly a lot of risk there, and a lot of the other things one can get across. You know, you can, if the resource is there, you can solve most of the technical challenges and so forth, and you can put contracts together that work. And there is, in fact, a lot of money at the moment looking at renewable energy and looking at Africa. So generally, that is not where the problem lies. The problem is to get that deal bankable, and the key thing around that, getting that deal bankable, is getting a bankable power purchase agreement in place, understanding the government support and how that's going to function. And then from a commercial perspective, what kind of risk mitigation can you secure from the development banking world or the export credit agency world?
Interesting. And another question that came in, Charles, I think I will address it to you, is if you compare off-grid to on-grid solar, is there a big difference in how, well, it's really different, but are most of the banks interested in both of the types of projects, or are they only interested in one of them?
I think we do see a lot of off-grid projects going on these days when it comes to West Africa region in particular. A lot of projects that we see also are coming from World Bank support to finance or put up a lot of bid when it comes to the off-grid sector. But these kind of structures are more complex, as the collateral requirements are a little bit different than larger on-grid project, where you have clear structure, just like was described in the other presentation, where there's a PPA in place and so on. Some of these projects that are off-grid, especially the mini-grid that we see these days, in some of the villages where you have to really have a distributed company who can really manage this mini-grid, and the challenges are really completely different when you compare both. But we do see a lot of opportunities when it comes to the off-grid market. During our market assessment that we did in the 8 countries, we saw substantial opportunities when it comes particular to the off-grid market as compared to the on-grid. We saw a lot of pipelines a lot of opportunities, and we are very encouraged by what the developers are doing in terms of the quality of these smaller size projects, which I think that's the only way that we can meet the challenge of the 2030 that we set for ourselves, to reach out to the last mile. And I think grid expansion exists. It's an opportunity for larger scale project, but still it's very it's very costly to developers as compared to the mini grid.
Thank you. And Jan, I guess off-grid it doesn't reach the scale for Nedbank to invest in, or am I wrong in this?
No, that's not quite right. I think we acknowledge that this is going to become too compelling a sector to ignore. But there are challenges in, as Charles points out, in financing these things. The risk profile does look different, and often the small scale is definitely not suited to the traditional project finance structure, because your transactional costs are quite high, and the smaller you go, those transactional costs sort of stay the same because it's the same amount of work. So you need to be a little bit more innovative, and we are certainly talking to a lot of developers and looking at a lot of business models, and there's some very creative things coming through, and we hope that, whilst I think the development banking market has really funded things thus far in the smaller scale market, hopefully as those markets mature and there's greater scale in terms of the number of consumers out there that is on those grids, and the business models mature, you will see more commercial banking interest.
Interesting. Yeah, definitely. So you will get a lot of questions from off-grid players in the conference, I guess now. One question that we got, Jan, also for you is there what's the minimum IRR that is needed for Nedbank or for any other commercial bank, you think, to close a PV project in Africa?
That's quite a difficult one. I mean, we don't really work with IRRs. What we tend to look at internally is a risk-adjusted return on capital. So it works a little bit differently with a loan than it would, for example, for an equity investor. I believe on the equity side, they need to decide what kind of risk appetite they have. I think on the more risky deals, I'm sure an equity investor would be looking for a 25 or a 30% return. In the more mature markets or on a lower risk deal, that might be lower. From a banking perspective, I think we would run. We try to be fairly competitive in Africa, and we like to think that we understand Africa reasonably well, and thus we try to be fairly competitive on margin as much as we can. Our funding cost is comparatively high, so we try to compensate for that through a lower margin, I would say, to the extent that we can really understand the risk, really be involved in the transaction, and try and control that contractual negotiating process so that we sort of get comfortable with that and then can offer the most competitive terms possible. So, I mean, to give you an idea, on some of the transactions we've done, an all-in interest rate could sit somewhere around 8%, I would say.
Thank you. And we're running out of time actually, so I want to ask a final question for both of you. Charles, I want to start with you. We see that in order to keep electricity tariffs affordable, most project developers requiring a long tenor, but that's difficult for most commercial banks, of course. What's your take on that?
Yeah, that's correct. Longer tenures are very challenging elements for most banks because of the requirement by the central banks in this region, particularly in West Africa, and that have a major impact on the tariff that can be offered as well, because the tariff that have been charged will help really determine the cash flow of the project. So we see many of this fund that have been put in place to help some of the commercial banks to have access to capital that can be lent on a long-term basis. You can mention CEFA at the African Development Bank as one of the funds that we heard about. So the key is to really provide access to some of these commercial banks of capital that can be used to finance particularly clean energy projects on a long-term basis. That's the only way to really make this project really bankable and be able to provide low-cost energy to to the end users.
Thank you, Jan. The last question that came in, the last question that I want to ask you that came in is what lessons did you learn from your experience in South Africa that can be applied to other markets? Yeah, so for instance, what type of policies are there in South Africa which are really beneficial for the development of projects that can be applied to other markets?
Sure, I think the main thing that we saw in the renewable energy program that South Africa had over the last few years, sadly at the moment it's a little bit under pressure, but in its heyday, I think the key was really clarity on policy from government side and full buy-in. So there was a very clear government support agreement, we call it the implementation agreement locally, that was very clear in exactly the support that you get from the Department of Energy. And that agreement was basically set in stone, so it was very clear through different rounds of bidding over a number of years. It didn't really change. So there was a clear message to the market and a stable message, stable contractual structure from government side, from the top, that just gave a very good and clear message, I think, to the market out there. And just below that sat a power purchase agreement that was also imminently bankable from the local utility. And we think that's really the key. It's not that there's risk, it's that as long as investors and bankers can understand that risk, and that risk is predictable, you can do something with it. You can mitigate it in some way, or you can structure around it. The challenge is often that the game changes along the way, or government changes its mind, or it's just not clear what the future holds and what the long-term strategy is. So I think clear policy direction from government, consistent through different governments, through elections, to be consistent and very clear to the private sector is the key. And if you have that, there will be appetite.
Thank you, Jan, and and thank you both for answering all these questions. And this brings us to the end of the webinar. I want to thank you all for listening. And like I said before, this webinar is a build-up to our Unlocking Solar Capital Africa conference. The information has been on your screen for quite a while. The URL is in the bottom. So if you have if you're interested in the conference, please click on the link and find out more on the website. If you want to know more, you can also contact me. My contact details are now on the screen, and they have been there for a while as well. I want to thank both Jan and Charles for your presentation and for answering all the questions. And I hope to meet all of you in Abidjan, or otherwise in one of our other upcoming conferences. Thank you all for listening, and have a nice day.